The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Wednesday. Look where we are. Karen and I in the studio, and well, Arabile's made it to a fish market in East London. You don't get any more glamour than that, I can assure you. At Squawk Box for you, these are your headlines. So the world's most valuable company, Nvidia, overtaking Microsoft on market cap after a blistering AI-fueled rally of more than 170% this year. Well, consumer complex Treasury yields actually decline after disappointing retail sales data bolsters bets the Fed is on track for easing later this year.
Volatility kills the Golden Goose. The luxury sneaker maker scraps its Milan IPO, citing deteriorating market conditions in the wake of the European election.
Why am I outside a fishing market? I'll tell you in a bit, but investors are potentially awaiting UK inflation returning back to target, with the last inflation print then before the election. That's due out at 7 a.m. BST.
We've gone from talking about 7 stocks at the start of the year to just one now, right? And that is one big name called Nvidia.
Yeah.
Subtle change on the markets.
Yeah, I noticed that Apple were down, 1.1%, Microsoft doing that. But as I noticed yesterday, I think we talked about yesterday, Microsoft's still rallying. But it's just rallying in a normal fashion for a tech titan, as opposed to Nvidia, which has just gone ballistic.
Yeah, absolutely. So what we're seeing, big moment of disruption for the major markets, that it's one big name that is now surpassing the others. So what we knew in terms of market leadership, and don't forget, you look at the bounce that takes place on markets, and usually it was a handful of stocks. Now at this point, it is one massive name, and it's really escalated past the rest. So let's just get into the Nvidia story as the shares jumped more than 3% Tuesday, sending the chip giant to a fresh all-time high. Shares in the company are now up more than 170% this year amid continued optimism around AI technology. That has made Nvidia the world's largest company by market cap, eclipsing rival big tech names Microsoft and Apple. The three companies have jostled for position this year, all racing to capitalize on advances in generative AI. Apple and Microsoft have been vying for the title of the largest US company for more than a decade, with 2011 the last time the title was held by another company. Let's get to Josh Corrin, who is founder and CIO at Musketeer Capital Partners. Josh, let me just bring up this bounce we're seeing in Nvidia, because it feels as though the market is backing it because of the AI story, so they want the growth, but they're also backing it because of concern around monetary policy, concerned about putting money in areas that may be still hurt by higher for longer stories around interest rates, but still technology is proving more resilient. So just talk us through the nature of Nvidia here.
Absolutely. Well, first of all, thank you so much for having me back on the show. I appreciate it. So like you said, it's really two stories. First of all, on the economic side, like you mentioned, now we're seeing macroeconomics slow down. So in terms of growth, for investors that want access to growth, during this time period, when we're seeing growth finally kind of slow down, job numbers come down across the economy, they have to access growth via a secular story. And Nvidia, just straight up, is probably the best secular large cap story out there that we've really maybe even seen in our time. So that's why you're getting this flight of capital to it. The other interesting thing about Nvidia, really this whole run up, was its valuation. So when the stock was $700, $800, $900, what was happening was it would beat earnings on these reports and guide up, and the stock would go up in tandem with the estimate revisions higher, leaving it always around 20, 25 times forward earnings. Now, finally, after the stock split, you're looking at a stock more like 40 to 50 times earnings. So finally, that multiple also really tacked on top of it. And that's the market kind of saying, listen, we think this growth is actually going to last. We don't think that this is really a peak right now anytime soon. And like I mentioned, the macroeconomic situation is leading towards secular growth. So the two things together, and really just the scarcity value around an asset growing that fast of that size, have led to this dynamic, and it's really just been unbelievable to see.
Josh, we know at some point there's going to be a rival that will encroach upon Nvidia's space. The market not looking at that at this stage. So how sustainable is this rally? Because it is taking with it not just one stock, but it's taking the entire market with it now. So how concerned do we need to be about a top-heavy stock market?
No, absolutely. That's a good point. I mean, I think that there's definitely room for concern. So every one of these quarters that Nvidia is now going to report, especially given the fact that now the multiple has caught up with the growth, are now going to be kind of a make or break point for the stock. So if Nvidia were to, let's say, guide down or just guide in line with consensus, right, that would mean that there's not any more of these estimate revisions the stock has been riding on. Further upside would only have to come from multiple expansion. And with a multiple that looks like 40 or 45 times forward EPS at this point, there's not really very much room for multiple expansion left. So it sounds kind of crazy to say, but it's really true. A lot of the market is really just riding on the reaction to Nvidia's future earnings prints. And it's really for this reason that we at the fund prefer the breadth catch-up trade, which is going after names that we see undervalued in the small to mid-cap space so that they can catch up with these overall indexes. And we think that that's where alpha is, not necessarily in the top-heavy index itself, or things that are so levered to Nvidia per se that already has that valuation like we talked about.
Josh, thank you so much for coming on, by the way, and I love your conversation with Karen. It's almost a shame to interrupt you two because it was going so far. But why should those small and mid caps catch up as well, given everything you said in your first answer, that actually things are slowing down? The broader economy is under a bit of pressure. The retail sales, yes, they did underline that as well as other indicators, just pointing to a slowing down. Given that, why should the others catch up rather than actually the market come down to realise that actually the things are a little bit tougher, and at this stage of the cycle, we take a pause for breath on the equity market?
For sure. Well, we've really had this phenomena around breadth now for years, right? So coming off the back of that first crash, you could say, post the COVID almost bubble, right? The breadth has been an issue where in the recovery, given the macroeconomic uncertainty, there was this flight to quality in large caps and mid caps have been left behind. And now going forward, we don't think all mid caps are created equal. But what we're looking for and we see are stories where you can access that secular growth. So like I mentioned, slowing macroeconomics, you want secular growth, whether that's penetration of a total addressable market, a shift within a market trend, right? You want to access growth in these areas. And then especially as rates get cut later in the year and going into 25, like we heard the Fed expect, from their last meeting, people will then also want to access duration. So secular growth plus duration as that interest rate comes down, because you can finally have an environment where these future earnings can be worth something. So we see these as the pocket of opportunity. Like, for example, one of the names I mentioned to the producer, Jumia Technologies, e-commerce in Africa, huge market, completely unpenetrated, less than 2 times sales. A name like this, we see really no downside after it's already down 80% from the peak and multi-X upside going forward. And these are the types of stories that investors stayed away from for the past 2 years because in a high interest rate environment, they just don't make sense.
Okay, that's extraordinary that there is a tech company out there that's on 2 times sales, given everything else we've just said there as well. 2 questions. Firstly, you own this stock, your fund owns this stock?
Yes, we own the stock. We're actually a large shareholder.
Great. Okay, it's fascinating. I've never heard of it. You tell me the pitch on this company. It's an e-commerce company trading in Africa. Give us the pitch on the company.
Yeah, absolutely. So high level, Jumia Technologies is the only platform that can move people, goods, services, and money efficiently at scale in Africa. Period. And their business is e-commerce, where they have a near monopoly, payments, and logistics. The company operates in 11 different countries in Africa. And simply put, this is a company that always had tremendous asset quality. It has a huge moat around it, and is really the only company that can efficiently operate like that in Africa. The stock had kind of a false start. So during the COVID peak, the stock reached all the way $60 to $70, which was probably an overshot then, but then undershot on the downside and came down to almost $3 at the low. the company installed a new management team that's just been doing a fantastic job. And what we've seen is over the past couple of quarters, growth reaccelerate from 9% all the way to 57% in constant currency the last quarter, making it actually the fastest growing e-commerce company in the world. While at the same time, you have you have losses that have approached nearly break even and gross margins that are industry leading. So 64% gross margin, which is actually higher than the likes of something like a Pinduoduo, which has much more scale than this company particularly. And that's just remarkable for a company at small size. So we're looking at a company that has the biggest TAM in the world, 1.6 billion people it covers, zero e-commerce penetration, a very low EV to sales multiple, like I said, forward less than 2 times, and massively accelerating top line growth rate with losses in check and going down. And we wouldn't be surprised to see them show profitability soon. So, this is a stock that today, it had a weak day, so it's a good time to buy the dip, but, it's around a $7, $8 stock now. We don't really see any reason why anyone would ever have to sell it lower than here. There's no debt on the balance sheet, plenty of cash to cover all of their operations in the future. No need to raise equity. And over time, we see this stock, getting back to that $60 peak that it had and much more. To put it at the same multiple as its peers would make it a $20, $25 stock by year end. So, a 2 to 3x this year. And after that, we think a multi-x from there.
Josh, let me circle back to where we started around this conversation on Nvidia, because this stock soaring past the likes of Microsoft and Apple. What we've heard from those two companies, Microsoft very much at the forefront with AI, thanks to OpenAI. But when it comes to Apple, it is leaning on others. It's got its AI platform, but really just powered by other key technologies such as OpenAI, ChatGPT. If you look at the AI offerings out there, where do you want to be positioned in the market around chips, or do you think it is time to think further down the pipeline in AI?
Well, I think let's just think high level. I mean, Moore's Law is going to apply here. So Nvidia really did have the first mover advantage, right? So from a technology perspective, you have that huge barrier to entry, and you're seeing that, right? Versus AMD, versus some of their competitors. And because of that, they've also been able to maintain pricing. But over time, look how much capital is coming to that space. So look at the numbers that we're hearing Sam Altman try to raise in OpenAI, right? And look at the Elon Musk chip startup that he's doing right now, and he apparently rumored to have raised a lot of money recently, pretty easily. So, as this technology develops, right, it's just inevitable that pricing on these chips is going to come down, and market share is going to become more of a battle. So we think that chips was something where the first mover clearly got rewarded. Look at Nvidia's valuation, right? But now going forward, you want to be where there's more of a competitive advantage. So I think that some of these more monetizable use cases, could be interesting now, like on the software side. But things that are a commodity are ultimately going to see pricing erosion just naturally, particularly with just so much capital coming towards that R&D spend.
Josh, fabulous. Very all-encompassing. Thank you very much indeed for some specific names and indeed for the wider chat as well. Much appreciated, sir. Josh Corran, founder and CEO at Musketeer Capital Partners. Right, senior US Commerce Department official Alan Estevez is meeting with the Dutch and Japanese governments in a bid to push the two countries to implement fresh curbs on Chinese chip makers. This, according to multiple media reports. Estevez will reportedly urge governments to restrict the export of key chip-making equipment, including systems created by ASML in the Netherlands. Well, coming up on the show, with markets stateside closed, attention turns to the UK, where investors are expecting the May CPI print to return to its 2% target on the eve of the next Bank of England rate decision. And later on, led on a wild goose chase. Yes, the puns were everywhere from our team this morning. Golden Goose pulls its IPO just hours after closing its order books, pinning the blame on political events in France. No, I'm sure it's nothing to do with the price. And Citroën unveiling its first all-electric SUV as it looks to put affordability in the driving seat. We'll be speaking to the CEO, Thierry Koskas, at 8:30 Central European Time.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Look, they're finally getting around to it. Bank of Japan policymakers, what do you think they debated? Yes, they did. They debated the impact of the weak yen on inflation in their latest meeting. On 57, what does it matter? Was it rallied from 80 over the last few years? Anyway, the weak yen on inflation in their last meeting, according to minutes out today. That is staggering that they should do that, isn't it? No, not really. They showed some members flagged the prospect of hiking rates sooner than expected if inflation surges. It represents a move away from the BOJ's stance. BOJ's stance than the impact of a weak yen on inflation would be temporary and not affect the timing of rate hikes. The minutes come after Governor Ueda told Parliament that a July rate hike was on the table. Not doing much to the Nikkei, Karen.
No, let's take a look at the Japanese stock market. You can see a fairly flat picture across on stocks out of Tokyo. Hong Kong rallying just over 2%. Very strong print for stocks there. But don't forget, a day earlier we had more appetite perched on Japanese stocks versus on Hong Kong names. So a real reversal today. Shanghai names in the red. We're dropping about 0.4%. And Australia giving back some territory today, down 1/3%. So choppy old session we're seeing across the Asian markets. To the US boards, and it was fascinating to see those fresh records for the Nasdaq and for the S&P 500 again. It was led by Nvidia, and you can see the real split between what took place in big tech names. Apple was actually the big moving name to the downside for the S&P and the Nasdaq, in contrast to the big AI story around Nvidia. If we look at the big US tech names, you can see FANG Plus stocks did not play in that rally, very much concentrated around the semiconductors, and Nvidia 3.5% up for that company as it became the most valuable company in the world. And as a result, Apple down more than 1%. You had Meta reversing 1.4%, Alphabet down 1.3%. So very much a concentration around the big chip stock.
What an illuminating chart that is. Thanks, Karen. Right, data. Now, I said to Sin, we've got to focus on retail sales yesterday, so they did a lovely preview for you, which I'm sure you'll remember. But the US retail sales fell short of expectations in May, rising just 0.1% month on month as consumers and retailers grapple with persistent cost pressures. It was the April print that I thought was interesting, though. The revision was down to a 0.2% decline. That's a big revision, actually, to the downside. The data buoyed market speculation about the Federal Reserve's path towards rate cuts. Should it have done, though? Because there was something else going on yesterday. I'll come to that. With investors upping bets on Fed easing. Did you guys all miss the industrial production figures, though? Did you? I'm not sure you did, because these were way better than expectations. And this really, for me, typifies the problem that the Fed is having as well. The fact is, the industrial output was way better than expected, up 0.9% in May. Auto assemblies up to 11.2 million. Why is that interesting? Because it was 0.3 million more than we saw in 2019. Interesting. Anyway, last week's FOMC dot plot pointed to just one cut before the end of the year. But the Fed funds futures market is once again betting on at least two. Of course they are. They're always so optimistic, aren't they? A number of Fed officials welcomed yesterday's cooling retail sales print as evidence 2 years of rate hikes are leading to a slowdown in consumer activity. They just cling on to anything, won't they? And cooling the US economy. Fed Governor Adriana Kugler said she'd seen evidence of a pullback in spending, and it's likely that will lead to a rate cut this year. Meanwhile, St. Louis Fed President Alberto Mussolem, in his first major policy announcement, said it could still take several quarters to see a sustainable period of favorable inflation data. Whilst the New York Fed President John Williams said he's seeing conditions moving in the right direction. But Bayat, good morning to you, sir. Bayat Vittman joins us, Chairman of Porter Advisors. But does the market care? Is the market interested? Because it's rallying to peak, and it is Nvidia, but it's not just Nvidia.
Of course, it's not just Nvidia. I mean, it's very favorable corporate earnings. So the market has powered ahead despite the lack of interest rate cuts. If I think about expectations beginning of the year and where we stand now, perhaps expectations of 1 or 2 cuts, but not more. So it's really earnings, and something is always leading the market. And obviously it has been technology for a long time, but it has been profitable technology. It's not like in the 2000s where you had kind of crazy business models with hopes and nothing and crazy valuations and no earnings and no nothing. So it's really well supported by fundamentals.
Are too many tech companies, which are profitable, I'll give you that caveat, trading at multiples which are unsustainable on the back of their hopes that they too will have the same kind of profitability in AI?
I think it's very extended right now, absolutely, but there is a structural trend, and AI will have across all applications of industries and geographies impact in terms of productivity, but that's a long-term topic. And short-term, of course, the market has anticipated a lot. So I would say valuations and price momentum is really stretched, but I think the underlying fundamentals are very sound.
It's interesting how confident you still are in the US markets after the size of this rally, because by comparison here in Europe, there's been a wobble thanks to the outcome of the parliamentary elections and the fresh elections called in France, enough so that Golden Goose has even cited it overnight as a reason to pull an IPO. Do you think there's now a different pathway for US versus European stocks, at least for now?
I think the US will, on a relative basis, perform less than Europe. So Europe has a lot of catch-up potential because there's a very large discount in valuations. But the US, I expect the US to perform well because the economy is very well on track. And the rally can broaden. The defensive sectors like healthcare, they have underperformed in this type of environment. So the market is very, very healthy and the economy is very healthy in that respect. But Europe, because of a lot of news and noise related to the elections and all other issues, higher energy cost has been really, really lagging and has to address really a couple of structural issues, energy transition, then capital market union, and then, of course, defense spending.
Sentiment is a big thing, and it feels as though Europe had the benefit of sentiment behind it for many months, that a lot of investors who've not really looked at Europe thought, well, it actually looks like there's a valuation trade here, there's a catch-up trade. But now, after the last week or so and the events that have transpired, it feels like all that noise has caught up with the sentiment and turned it. Do you think there is a change? Are you noticing that investors are just thinking, look, there's too many populists, there's too many extreme parties in Europe for now, let's just place our bets elsewhere?
Well, there's a lot of granularity. The elections have been orderly, peaceful, non-contested in Europe, let's face that. And then the far right made the inroads in France and in Germany. Obviously, they are the two pillars of the EU, but elsewhere, not really. I mean, Italy is a confirmation, not in Eastern or Northeastern European countries. So I think there is really a valuation gap for Europe, and we have reached negative extremes in terms of sentiment. So I'm very bullish for European assets, be sovereign debt, OATs, or European equities, German, French, and also the UK, which I think has significant potential at this stage.
And that is fascinating, isn't it? Because we have seen so many comments from, in fact, we've got another one, I think, coming up later on the show, from big houses who think, actually, because of what is going on politically in France, we need to pull back. Actually, you're saying the opposite. These were orderly, democratic elections, regardless of the result, which actually won't affect the business community or won't affect the way that corporates are conducting activity, i.e. it's a golden opportunity to buy in?
Well, we see that the sentiment is affecting, of course. The French stock market has been down. The spread has been widening of OATs to bonds very, very clearly. But I think that's a great entry point here, because at the end of the day, it depends what the elected politicians and the leaderships will do or not do. And the markets are teaching them a lesson ex ante already. So I think it's great entry points.
What do you like in Europe? Because we were noticing on the balance yesterday that you had some of the beaten up areas of the market that were picked up. A lot of these were cyclical areas of the market. Cyclicals in Europe or defensives?
Well, I like industrials and defense because there are multi-year contracts there and there is transformation ongoing. And then, of course, I like the core markets in Europe, Germany and France. And then, of course, the UK, very interesting. And I think the elections the changing government will be a big boost to the market long term.
Can I just bring up the timing of the markets now, because we've had a lot of positive comments around where to invest. I think the market is waiting it out, it seems, for this first Fed rate cut, whether it's going to be September. Some of the more hawkish language suggests later in the year. If that is the case, how do markets trade between now and year end? Is it going to be bumpy as investors wait it out for some form of a rate cut from the Fed, or at least signalling?
Not really. I think we have pretty steady markets in the US. We have a gentle slowdown if you look at labor market data very clearly, so that's healthy. The only thing which makes me nervous, and I think that's the biggest macro risk this year and next year, is a contested election in the US. I think neither Trump or Biden would be negative for the market and the economy for next year and beyond. But I think a contested US election, would lead to policy paralysis in the US for months, and that would be negative. And the US is so important in terms of economic weight, economic performance, via also the dollar, that it would impact all markets around the world. So that's the key risk, not all the other geopolitical risks which we have, including the wars, of course, in Ukraine and the trouble in the Middle East.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.